Comparative analysis of Netflix, NFLX, against its key streaming competitors, Disney+, DIS, Amazon Prime Video, AMZN, HBO Max, Max, WBD, Apple TV+, AAPL, and Paramount+, Para. The data used is from the most recent available annual, TTM, or quarterly periods. 2. Ratio analysis and comparison. The following table presents a side-by-side comparison of 15 key financial ratios for Netflix and its competitors. Please note that for companies like Amazon and Apple, the streaming service is only a part of their massive business, which heavily influences their overall financial metrics. WBD and Para are primarily media companies, while Disney is a diversified entertainment giant. Ratio Netflix, NFLX, Disney, DIS, Amazon, AMZN, Warner Bros. Discovery, WBD, Apple, AAPL, Paramount, Para, Valuation.
PE ratio, TTM, 51,28, 17,84, 35,33, NA, 33,86, NA forward, PE 38,46, NA, 7% PEG ratio, 1,33, NA, 2,25, 3,06, PB ratio, 21,5, NA, PS ratio, 12,27, NA, EV, EBITDA, NA, profitability ROI, percent, 42 chief, net 83,84, NA, net profit margin, percent, 24.58, NA, 10.5, NA, 24.3, NA, operating margin, percent, 34.07, NA, gross margin, percent, NA.
Financial health DE ratio 0.58, NA 125, 0.83, free cash flow, TTM 2.66B, NA 30.48B, NA growth and efficiency EPS growth, YOY 47 to 30%, NA 59%, 8.69%, 12.14%, 15.91 up 67% revenue growth, YOY 50.90%, NA 12.60%, NA ROA, 15.05, NA 10.0, NA export to sheets. Note, NA indicates that the data was not readily available or comparable across all sources for this specific period. Ratio interpretations, PE ratio. Netflix's PE of 51.28 is significantly higher than Disney's and Amazon's, suggesting investors are willing to pay a much higher premium for Netflix's earnings. This indicates strong investor confidence in its future growth potential. Forward PE. Netflix's forward PE of 38.46 is also high, but a notable drop from its TTM PE. This suggests analysts expect its earnings to grow considerably in the near future, which helps justify its current valuation. PEG ratio. Netflix's PEG ratio of 1.33 is favorable compared to Apple and Paramount, which have much higher PEG ratios. A lower PEG is generally better, implying a more reasonable valuation relative to its expected earnings growth. PS ratio. Netflix's price-to-sales ratio of 12.27 is very high, suggesting that its market capitalization is significantly higher relative to its revenue compared to competitors like Paramount. This often indicates a company that is still in a high-growth phase and valued more for its future revenue potential than its current sales. ROE, return on equity. Netflix's ROE of 42.5% is exceptionally strong, demonstrating its ability to generate high profits from shareholder investments. This is a testament to its efficient business model and profitability. Amazon's ROE is also strong at 23.84%. Net profit margin. Netflix's net profit margin of 24.58% is excellent and a strong indicator of its efficiency. This means it's keeping a significant portion of its revenue as profit. Apple's is similar, but that reflects its high-margin hardware business, not just its streaming service. DE ratio, debt to equity. Netflix's DE ratio of 0.58 is lower than Apple and Paramount's, suggesting it relies less on debt financing. This indicates a healthier financial position with lower leverage risk. Free cash flow, FCF. Netflix's positive FCF of $2.66 billion shows it's generating more cash than it's spending, which is a great sign of financial health and operational efficiency. While Amazon's FCF is much higher, its business is far more diverse and complex. EPS and revenue growth. Netflix shows strong YOY EPS growth, 47.30%, and a robust revenue growth of 15.90%. This indicates that the company is effectively expanding its top and bottom lines. While WBD and Para have astronomical EPS growth figures, they are likely coming off a very low base or even negative earnings, making those numbers less meaningful for comparison. 3. Industry context. For the streaming and broader media and entertainment sector, valuation ratios can vary widely. P/E ratios for mature, stable companies can range from 15-25, but for a high-growth tech or media company, P/E ratios in the 30s, 40s, or even higher aren't uncommon if investors have high growth expectations. Netflix's high P/E falls into this category. Profitability ratios, like net profit margin and operating margin, are crucial. High margins, over 10% for net profit, are considered healthy and show the company has pricing power and cost control. Netflix's margins are strong, especially given the content-intensive nature of its business. D/E ratios typically vary by industry. For a capital-intensive industry like media production, a D/E ratio under 1.0 is considered healthy, indicating a manageable debt load. Netflix and Paramount's D/E ratios are within this reasonable range, while Apple's higher ratio is managed by its enormous cash reserves. 4. Overall assessment. Based on this comparative analysis, Netflix, NFLX, stands out as a financially strong and efficient company with a premium valuation. While its high P/E ratio suggests it's an expensive stock, this is supported by its remarkable profitability, robust growth metrics, and efficient use of shareholder equity, as seen in its high ROE. Its lower debt-to-equity ratio compared to key competitors indicates a more conservative and stable financial foundation. In comparison, companies like Disney and Amazon benefit from their diversified business models, which dilute the specific performance of their streaming units. WBD and Paramount appear to be in a more volatile or transitional phase, as suggested by their non-existent P/E and a mix of negative and very high EPS growth figures, likely from efforts to turn a corner. In conclusion, Netflix's financial ratios collectively suggest it is a high-quality, growth-oriented company that has successfully navigated the highly competitive streaming landscape. While its stock trades at a premium, this is a reflection of its market leadership, financial health, and perceived future growth potential.